Thank you, Aditya. So, so before I start the session, let me highlight one very important thing. You might have many questions which we may not be able to cover in the last 10-15 minutes of our time. But still, the request would be that you can keep throwing those questions to Aditya. If we are able to answer this as part of this program, we will certainly try to. My first endeavor would be that hopefully I should have covered a lot of your questions as part of the presentation itself. But if not, and if there are questions that go unanswered, please feel free to raise it to Aditya. We will try and address it alternatively also if we can. And I think that's something which is very natural to come from somebody who believes in alternate investments. This is an alternate style of answering your questions, both together. So very quickly, let me move into the presentation part. And a little context of this first. Our understanding is that alternate investment funds, though have close to about 8 years of history in India, is still not understood that very well by the distribution community, and in some sense even by AIF managers in terms of expectations of the distribution network. This is still evolving. It was evolving then, it is evolving now. The scale at which the evolution happens could differ, but we are all students in this game, and we all keep learning every day the way it unfolds. But it's important for us to have a quick basic understanding of the distribution network, how to scale up the business around AIF in particular, and what on the other side AIF managers also should be doing to make it little better for everybody's outreach. So this is just a presentation aimed at providing some insights into the distribution network. We'll talk about our learnings of this entire journey and everything towards the end. Let's first focus on what AIFs are, what the manner in which AIFs are looked at by the distribution community, and the way in which this can actually grow going forward, and what each and every other participant would be able to do. So very brief, there are only 3 topics that we're going to talk about. Why alternate investments? And this is from a distribution network angle. So I'm not going to talk about the other theoretical aspect of it. This entire 3-day session that we have starting today is going to cover too much of things. There is no reason for us to duplicate the same content which the other speakers are going to speak. Very briefly, why alternative investments? Some of the industry data, which is what are important for us to sort of know. And then finally, the ecosystem around distribution. So why alternate investments? Our firm belief is that you can't do today's job with yesterday's methods and also be in the business for tomorrow. You need to evolve as things unfold. And I keep giving this one very simple example. When debit cards came in the banking system, there was a lot of resistance. People believed that this is not the way money can ever be transacted. I do not know in the last 5 years or 10 years how many times you would have gone to a bank now for withdrawal of money. It just doesn't happen. Whenever there is any change, there is always going to be some degree of resistance for change. And alternative style also had its own challenges, but they are here to stay. And what do we mean by alternate investments and all? Again, I repeat, a lot of these things are going to be covered as part of the presentation, but since these are early presentations, I may have to touch upon that very, very briefly. So before moving into the subject, let's understand, AIF is a term, but its constituents would differ a lot from the risk and reward perspective. Every product in the alternate investment fund as a category is labeled as AIF only. Not too many investors or not too many other partners also understand broad differences between category 1, 2, and 3. Even within category 3 or any other category, there could be huge differences in terms of risk profile of each and every investment product. But whether we like it or not, each of these are known as AIFs. It's almost the same as what we have looked at mutual funds. If instead of equity funds, debt funds, or liquid funds, if we were to call each and every mutual fund as a mutual fund, then the entire risk and reward perspective of an investor can undergo a change. But fortunately enough, there are sub-classifications which are loud and clear in mutual funds. Unfortunately, in AIF, AIF 1, 2, and 3 is the only popular categorization. But within a particular category, there could be huge differences, is what is not known to too many people. I'm very sure this 3 days of academic time is going to provide a lot of insight in this. Second belief that we have, which is our very strong belief, is that this is generally speaking not a substitute of your core part of the portfolio. We have nowhere, this is known as alternative, this is not the core. So an investor's portfolio would typically be based out of your mutual funds or stocks or bond investments only. It's only when an investor requirement is of a different type, where you need to go to a slightly more sophisticated investment vehicle, is the time you come to an alternate investment. So this is not a substitute of the core part of the portfolio, is what we highlight. It's extremely critical for someone to actually do the investment fitment and assessment whether this is really required into an investor's portfolio or not. These are not the products which are meant for every investor. But for certain investors, this becomes a necessity. And under what circumstances it is, this is something which we have to learn over these periods. As I said, another important aspect, there is a big difference between alternate investments as a term versus alternate investment fund as a category. There are certain things which are not covered as alternate investment funds, are also alternative investments in certain ways. So for example, structured products, there is no fund which is a bundle of structured products, but independent structured products do exist, and they are also termed as alternative investments. Every investor, every distributor, wealth manager in general, everybody, or even AIF managers, should always look at one thing, that is an AIF adding any meaningful difference to whatever is easily available in the market? If it doesn't, then that alternative investment has almost no value. So these are very typical, basics for us to sort of understand. Now comes the important part. Do people allocate money to alternate investments? And if you look at the way institutional investors look at this and the way in which individual investors look at this, there is a vast difference. Alternative investment historically has been, as a category, has been more tuned towards institutional investors. But that is true for all asset classes. It all begins with some of the larger sophisticated investors, and then it becomes a norm. And a lot of people then start participating in this. We keep on saying that you have a lot of global funds which are there in India today. Why are the mutual fund route? If the same funds were introduced way back in late 90s, there could have been no takers. So there's always a right time for every product. The primary reason for institutional investors to invest in alternate assets, the most important reason is diversification. Almost related stuff, but low correlation to other investments or other asset classes is another very, very important factor for them. Third comes the higher returns expectations as compared to the other conventional form of investments. And then comes risk management or reduction of the overall portfolio level volatility. The other things do not have much of significance. But if I look at the top 5 reasons for someone to look at alternate assets, is predominantly for diversification, which is also somewhere part of your risk mitigations. It's more to do with controlling your risk, controlling your correlation than anything else. But this is true for institutional investors. Come individual investors, excluding the family offices, the entire dimension changes. Performance of a fund matters the maximum to most of the individual investors. Then comes whether the strategy has a fitment or not, or the experience or the pedigree of the portfolio manager and all of the things, if they were considering anything in name of investments in AIF. Now let's understand the first one that we saw about was institutional in nature and why do they invest. Here, what matters to the individual investor, as I said, is not just why do they invest. How do they select an alternate investment fund is also an important criteria here. This is excluding the family offices. Now, as I started by saying that these are more institutional investments in nature. If you look at the long history of most of the pension funds and endowment funds in the US, and the reason why we take US example here is that in India, we do not have a long history for us to talk about. We do not even have credible data for us to talk about, unfortunately. So then you rely on geographies where there is a lot of data, and those kind of geographies from where there is a lot of inference that we can take. So if you look at how the state and the local government pension funds have increased their allocation to alternate assets over the long period of time, it's typically the fixed income which has lost money to alternate assets. Multiple reasons for it. If you are running a pension fund and if your fixed income returns are slowly and steadily going down, you need some kind of an alternative idea for you to be able to manage your pension fund better. So not much has changed in the public equities, but alternate assets has grown at the cost of fixed income and cash significantly. We see almost the same trend in endowment funds, which are very long-term in nature. Because these are long-term investments in nature, it makes even more easier for managers to give higher allocation to alternate assets. So if you look at here, even the public equities have seen a little bit of a dip in terms of allocations. Of course, fixed income and cash has got narrowed much more. And the alternate asset as a category has grown significantly higher in this period. When these are also known to a lot of people, these are like illiquid investments, but let's also understand in Indian context, a lot of Indian AIF options are highly liquid in nature. Some of them offer you monthly liquidity or quarterly liquidity, which is good enough for most investors to plan their investments. And even for wealth managers, it gives a corrective course of action if you believe that things are not going well. So those kind of options do exist. And I'm sure you will learn over the next 2.5 days a lot more on this. But this data is a very important inference for us to take. That if the money is for long term, alternate assets as a category is here to stay. Now I'll give another very practical example. Anybody who is client facing in the wealth management industry, and if a client would come to him and say that we are looking at investment into equities, into listed equities, what would be the expected returns and what would be the time horizon that we should look at? Obviously, a genuine good wealth manager will not talk about returns and not promise returns on this, but would quickly jump in and say that you should come into listed equities only if your time horizon out for your investments would be 5 years and above. Gone are the days where long term used to be more than 1 year. If you speak to somebody 10 years back, somebody would have said anywhere between 1 to 3 years is a long term investment. Today, a definition of long term has become very easily something which is beyond 5 to 7 years. Otherwise, this can have huge volatility, and I'm talking of public equity markets here. Why alternate assets have become a little more popular is that most of the alternate investment products which are there in India, whether it is real estate private equity or venture capital fund or private equity, these are all for investment period ranging anywhere between 4 years to 8 years as time horizon. Now, if you're listed equity, if you were to come with a time horizon of 5 to 7 years, then a 4 to 8 year kind of a time horizon for alternate assets is not significantly different. But if with that time horizon, if it has a potential to generate slightly better returns, and if you're willing to take the liquidity risk of the product, then those products do have a fitment in the portfolio. And that's exactly what we are seeing in the recent data points. And that's the reason why alternate assets as an industry is growing well in India. Okay, so let's look at some of the industry data in an Indian context for us to form some better opinion or at least learn a little more. We always use these words that opinions are good, data is better. Let's look at, before we move to the data, let's first look at the categorization that we have from SEBI as far as the 3 categories of AIFs are concerned. And I will be quick in this because this will be a lot of repetition for you during these 3 days. Essentially, let me go reverse. Category 3, which has been recently a lot more popular as hedge funds, they are typically the long short funds which will invest in long and short, both sides of the market. They have the flexibility to take leverage. Category one would be your early stage startup investments, your infrastructure funds, and likewise the angel investing categories and all. And anything which does not fall into these two, which is your private equity, debt funds, real estate funds, even fund of funds and all, this will all be classified as category two. I'm sure in the next 2.5 days, you will be expert in this three categorization. But let's look at some data now. This is a long history, or not so long history either way, of data that is available till 31st of December 2020. This data is available on a quarterly basis, but generally with a lag of about 45 days at the end of the quarter. So maybe in the next 10, 15 days, we will have an updated data of the financial year ending 2021. But if you look at, the industry has grown nearly at an 80% compounded annually, if I consider the very base, but that's not probably the right way to look at. But these figures in crores will indicate you that this is one of the fastest growing industry in India. Much more than even from a rate perspective, much more than even what we have seen in the portfolio management industry over the last 20 years plus. Now, category 1, 2, and 3, if we look at the commitments, of, most importantly, most of these funds is, there would be of those types where you don't have to give the entire money upfront. You have the freedom for you to commit the money, but you can keep giving money in installments or drawdowns, as we call it. So whatever is committed is by and large, with a little bit of lag, is definitely going to be a fundraise. And whatever is a fundraise, with some degree of lag, is always going to get invested somewhere. Therefore, this industry growth is a very significant growth for us to look at. Even if suppose these activities come to a standstill because of COVID or other reasons, investments can still continue. It's not going to come at a complete standstill, is for sure. Now, if you look at another important point, as on 14th of April, there were 738 registered AIFs in this country. If I look at this versus a relatively comparable industry of portfolio management, we have close to about 350 portfolio managers registered in India versus 738 in AIF already, and in a much smaller period of time. One thing which it clearly means is that we have seen a huge surge in number of AIFs in this country. But I will also come to a very important part why this number is a little misleading and what is it that we should read out of it thereafter. Year-wise, what has been the traction of AIF registrations? We saw AIF registrations really pick up from 2017 onwards in most of these cases. Where are most of these AIFs based out of? Now, if you look at whether it is venture capital, private equity, which constitutes a very large part of these kind of funds. In terms of startup activities, Bangalore is leading the pack with a huge margin as compared to any other city in India. But when it comes to fund, the financial management activity of startups or venture capital fund or real estate or anything for that matter within AIF, Bombay accounts for nearly 60% plus of the total registrations in India. Just for academics, this doesn't mean anything different. There could be a much better quality fund from any other remote location, which is part of others also here. So we're not trying to generalize anything out of this immediately. But what I would certainly want to highlight is that while we have 730 registered AIFs, there are very few which accept money from individual investors or which reach out to wealth managers and ask for mobilization. AIF in India, to a large extent, is an institutional process. There are institutional investors who invest in this. There are some set family offices who invest in this. But there is very limited individual investor participation in AIF as yet. We had done one another study, and for the sake of keeping the things very simple, I'm keeping it outside the purview of this presentation as of now. But we had looked at one stage about a year back of the top 50 venture capital funds in India, for an example. And interestingly enough, only 6 out of those top 50 names were accepting money from individual investors through wealth managers. Others were focusing only on family offices and institutions. So it clearly means that AIF as a product is predominantly a family office or an institutional product at this point of time. Things are changing and changing very fast is what we'll come to. So if I look at the entire AIF distribution ecosystem, there are 4 constituents for us to look at. The first constituent is the regulators. In fact, it is regulator and not regulators because we have to look at SEBI only for this. The wealth managers, the AIF managers or the manufacturers of such products, and the investors. Now, SEBI, if we talk about, as far as AIF registration history is concerned, we are less than a decade old in terms of this. So there were no AIF registrations prior to 2012. There were very few that happened in 2012, and then it started taking off. One important barrier which has been there for most of the AIFs, and the reason why individual investors have not embraced it as much, is a barrier of investment ticket size as one important barrier. There are not many, but I'm just highlighting one right here. The other thing is these are more in form of private placements given. So public information or information in public domain is limited. And if the information in public domain is limited, obviously the scope of its wider circulation or wider acceptance would be relatively less. On a comparable basis with some of the other industry and sub-constituents of SEBI, this is less regulated. Now, one of the reasons why it is less regulated is it's in form of private placements only. Anything which is in form of private placement will always have lesser regulation. But there are a lot of compliance requirements which are there. So less regulation doesn't mean that this product is something where I can raise the money and run away from the market very easily. No, it doesn't happen that way. There are very, very strict regulatory framework and compliance which I need to comply with. I need to have a lot of other support ecosystem for me to prove that I can run an AIF. So it's not a fly-by-night kind of a structure by any means. AIFs have now started becoming important to the regulators, and that's something which is visible with a lot of small steps which SEBI has been taking to sort of fine-tune the entire AIF industry now. One another factor is that recently, performance benchmarking has been introduced. Long way to go for it, but at least at this point of time, there is some kind of benchmarking for various years of vintage is something which is begun. And we believe that once this becomes more streamlined, it will become a lot more easy for an individual investor to take calls. However, mere performance is not the best of the criteria to choose an AIF, but that I'm sure the wealth managers will take care of in the right time for an investor. Transparency and disclosure remains the key to success. Today, there are reasonably decent disclosures for registration of AIF and complying with some other guidelines. But the disclosure to the investor time and again is still, we would say that it requires a lot of change, and there is a lot of scope for improvement here in that sense. The good part is that there are certain AIFs which are raising money from individual investors that voluntarily have adopted some of the venture capital norms of global markets and have improved their disclosure mechanism exceedingly well. They are almost like setting the benchmark even for SEBI to follow in certain fashion. So some of those players in the AIF space have done a pretty decent job, which is giving comfort that this space will remain investor friendly in the days to come. Personal belief is that there is a strong need for sub-categorization, including the nomenclature. And I will highlight one example here. We all know that every asset class will have their own cycles. Today, we talk a lot about Bitcoin, and I don't want to get into the technicalities of the rights and the wrongs of it. Some years back, there was a belief that in real estate, there's nothing that can go wrong. And then we had a period of 5 to 8 years, last 5, 7, 8 years, where real estate has not lived up to the expectations of most of the investors. Now, we have come across many such cases where an investor would have invested in an AIF in that space a few years back. And then we'll come back and say that we have had bad experience of AIF, we don't want to invest in AIFs any longer. But the unfortunate part was that you invested in a real estate category which had its own cycle, and you chose the wrong cycle to invest in. Now you generalize and say all AIFs are bad is a little unfair statement for AIF. You need to have subcategorization and focus on a subcategory, micromanage it, and then take a decision whether it is worth it or not. So don't go with the nomenclature of AIF. Look at the asset class, sub-asset class. AIF is just a category name given to those kind of investments. And when such things happen, many times I quote, and which is a very unfortunate but a very true statement, poverty anywhere is a threat to prosperity everywhere. One bad experience and you generalize everything and say everything within AIF is bad is a very unfortunate thing. The reason why I'm putting this point in SEBI's classification or regulators' classification is only because that there is a need, and this is my strong belief, there is a need for subcategorization through a nomenclature process so that it becomes easy for an investor to understand the differences between 2 or 3 categories of AIFs. Let's move to the wealth manager part of it. I'm using the word wealth manager as a very generic term. This would include in SEBI's definition what is known as distribution or a mutual fund distributor or a registered investment advisory or banks or anything for that matter. Any intermediary who is evaluating alternate investment funds and bringing it to the investor. In general, I'm here for the purpose of this presentation, I'm classifying as the wealth manager. It could be any nomenclature and I'm not going into that technicality right now. My first and very unfortunate statement for me to begin with is, generally, it has got a very poor understanding, this category. There are very few who understand it right. No fault of theirs, largely because that if this product has been more institutional in nature, there has been less need for the wealth manager to understand this ecosystem better and do their adequate due diligence to sort of take it to the investor. Also, if I have been doing a business in a certain fashion, it's very difficult for me also to change my business model and include any new category so very easily. Only the ones who are adaptable enough to outside changes are the ones who are adapting to AIF regime. We believe that more and more people will have to embrace AIF in the days to come. But right now, poor understanding is one of the important factors. That's a reality. We believe that it is not adequately used for diversification. Or we say that it could have been used far better. Let me give an example. We have seen a lot of cases where the investor would have been having a fairly decent exposure to listed equities in India through direct equity or through mutual funds or through PMS. Then if I go to him and talk about a listed equity AIF, I'm not giving him a meaningful diversification. I'm giving him an AIF as a category. I'm giving him a diversification of a manager. If that AIF has a different theme, I'm giving a thematic diversification also. But it certainly is not an asset class diversification is what one should know. Therefore, the belief is that if it is used for diversification, it should add to the correlation angle also into the investor's portfolio. It should be negatively or far less correlated to the other part of the portfolio. Then it makes a lot of sense into investor portfolio, which is what the wealth managers need to look at and consider. Then there are many options within AI for them to pick and choose. But according to me, a very significant reason is a lack of knowledge on underlying, which remains the biggest bottleneck. If I don't understand startup business, if I don't understand venture capital, I can't sell a venture capital AIF, or I should not sell a venture capital AIF. For me to sell equity fund, I need to understand equity markets. For me to sell debt fund, I need to understand underlying bonds and the bond market ecosystem. It is obvious that you need to understand underlying before you talk about a package product to anyone. AIF is no different. So if you're talking about any AIF category, Before that, you need to have reasonable understanding of the underlying category and talk about something. If I don't have any idea about how real estate ecosystem work, I better avoid real estate. It's as simple as this. So to have knowledge is important. Now, a related point is, unlike mutual funds, in AIF, there has been almost nil orientation or very limited in the name of training and development for this segment. Very unfortunate, but that's a reality. There should be more and more training programs, and I'm sure with AIWMI, we will work out on this very soon. But idea is that there needs to be a lot deeper understanding of the underlying and of the packaged product both. In absence of that, most individual wealth managers or independent financial advisors or whatever nomenclature we use will find it very difficult to embrace an AIF. Result of that is that there are very limited participants. Another factor is that once the number of participants grow, the competitive pressure puts that pressure on me for me to start looking at AIF that more carefully. But today, if my neighbor is also not selling AIF, I'm also not required to sell an AIF. That's the mindset with which the wealth management community is working today. Is my soft and very simple allegation on that industry. Other important factor is that we are unable to comprehend the cost and revenue structures in this. Some AIFs are very costly from an operational standpoint, and therefore they may be a little costly. Some AIFs do not have much of operational cost. So you need to understand there are a lot of people who have had these allegations that AIFs are very costly products for an investor. In some cases, it is because of the operational cost and the ecosystem. But then, wherever such kind of costs are incurred, the payoffs are generally speaking much better. So if you look at from a payoff perspective, it may not necessarily be a net costly product to somebody. But that's a cost-benefit analysis that one needs to do as part of the due diligence. What we call as mental bottlenecks before people even hear about AIF is that we just discard off by saying that they are illiquid products. Most often, at least I would say that a good part of AIFs do not have illiquidity. Opacity in reporting is another allegation, which is again changing very fast. There are a lot of AIFs which have mandated monthly and quarterly updates as part of their communication mechanism to the end investor. There is no reason for us to have that kind of a belief. And that's a basic due diligence requirement which we do at the start before interacting also with an AIF. So I don't think this should come as a bottleneck even thereafter. Somewhere, revenue point of view, there is a little disconnect because in some categories of AIF, wealth managers feel a little dissatisfied with the kind of revenue systems that they earn. Very little can be done about it from the cost and revenue structures that are there for operational matters. But hopefully, as the size of the industry grows or size of a particular fund grows, things will certainly improve. Last but not the least, there is a very big need for due diligence and ability to do due diligence on the right kind of product. This is where the wealth manager will have to work slightly more actively. Now, why we say that a wealth manager needs to have a foresight of what is coming up. So let me first go here and say this entire journey of last 8 odd years that we have seen for AIF, if a wealth manager has not participated in this journey, somewhere he has missed out as a reality. Why you should not miss out the trend? I'm giving this very simple example, hiding the name of the company right now. A very old company, and I can assure you, we have used the product of this company. Most of us would have used the product of this company in the past. They were leaders in the segment. No surprises, and I don't like giving long surprises. I'm talking about a company like BlackBerry. They believed till 2007 that they are the world leaders. When iPhone was launched, they said, what's the use of a phone if it does not have a keypad? Nobody will use it for emails ever. But as they say in disruptive times, changes happen gradually and then suddenly. The same thing happened with this company. To wealth managers, we say that it's important to see the future. You say no, there's no problem in saying no, but you say no after proper understanding. Don't disregard a product category which is growing so fast, so easily. That's the only humble submission that we have. I come now to the AIF managers. Problem with AIF managers have been that there is very poor understanding of distribution network for them. And I know that in this audience, there are going to be a lot of AIF managers as well. Let me give a very typical example. This is not true for all cases, but one such, and not one, but few typical cases that we have seen. How would an AIF get created? An AIF gets created, generally speaking, and we, on a lighter note, we say that AIFs get created more in coffee shops than anywhere else. It's a coffee shop meeting which brings 3 or 4 friends together to decide that let's start something of our own. These are 3-4 people who would have worked a lot in the industry with a fairly decent industry domain understanding. They would have been smart fund managers in their own right. But those smart fund managers in a group of 2 or 3 will come together and decide that let's launch an AIF and we ourselves will become an entrepreneur and run 500,000 or 2,000 crores of money over a period of time. Now with this aspiration, when 2 or 3 people come together, they start putting up all the drawing plans and all. They are all subject experts in their own way. They are great analysts of the underlying businesses. What they miss out is that they can be very good in identifying companies to invest in, but they are generally not so good in identifying where they will get the money from, because they have not been in the distribution side of business. And in case of AIF, it's not an open-ended structure like a mutual fund where you will have a large sales team, which will keep building relationship with the distribution community at all times. Therefore, you can't have a qualified salesperson or a business development person within an AIF that very easily. I've seen many AIFs where a fund manager doubles up and also interacts with distribution partners or clients, which is not his forte. He might not be good enough in terms of communicating because he would be a great table worker evaluating companies. So because the AIF managers do not have adequate understanding on distribution side, the outreach becomes a little weaker. I would go to 10, 15, 25 wealth managers, the top names that I have in my mind. And if I don't get response, that fatigue will come in and I will start saying that wealth managers don't understand what I'm trying to give. But the reason lies in your inadequate understanding of the distribution business. With few, there are pedigree issues, and that affect others also. So let me give an example. There are people who come with a decent enough understanding, launching their own maiden first AIFs, they will have success, no questions on this. But there are some people who would have had great personal experiences with no one outside knowing that you've done a great job. And that person with even a decent enough track record of his own managing personal wealth will find it difficult to raise money from outsiders. Because outsiders or the distribution community will look at pedigree on paper for them to be comfortable enough to onboard a product. That's as basic as a wealth manager would do. And there's nothing wrong in it either for a wealth manager. The other challenge that happens for a wealth manager, for AIF managers, is they start with great expectations, which is where the expectation mismatch creeps in. Less time is devoted in building the knowledge base for wealth managers because you launch an AIF and you immediately want the money. You need to spend time in the industry for you to build the knowledge base for wealth managers to then come in and start contributing. So this is a long process if there's an AIF manager who wants to raise capital. AIF capital is extremely rare that you get an AIF capital, and particularly if you're launching your first fund, for you to be able to raise adequate capital in time. There will be time overruns. And as long as there are time overruns or even otherwise, most of your investments will get scattered over a period of time. The only difference is if you're running a listed equity AIF or a hedge fund, then you don't need to phase out, and then there are no drawdowns. You give the money entirely upfront and it works accordingly. Last but not the least, we need to learn from what the mutual fund industry did for the development of the industry. There are some great industry stalwarts in the mutual fund industry who worked very hard to create this as an industry. Unfortunately, in the AIF space, as on today, it remains fragmented, though we are now seeing changes. And the newer and newer bodies, including the Association of AIFs, the Indian Association of AIF, those kind of bodies have started coming in for creating or becoming an industry body. So this is one aspect for AIF managers in terms of their distribution structures or ecosystem. Last, the investor part. Investor would always need credible data and research before taking decisions. We need to focus a lot more on data. Stories can happen thereafter. Actually, we keep on saying that data should narrate the story automatically rather than selling on stories. Need more choices to be presented with. These are not the products where somebody can go out and say that, look, this is one product that you should go out and invest in. The investor will need choice because the understanding that the investor could have of the needs would be very different than what a wealth manager could represent on the alternate space. So if the mapping of the risk and the risk profiling is done exceedingly well, then it's good. But otherwise, this can be a double-edged sword for a wealth manager. So it's extremely critical that investors have adequate understanding and good number of choices in front of them for them to take a decision. And investors should have little more direct access to managers of this kind of products, because that communication mechanism should be direct. The wealth manager is always going to be part of the exercise, but as a little bit of direct communication is definitely helpful. This is what constitutes the entire distribution ecosystem for someone to have a broad understanding that we have had over the last 7.5 years plus that we've been in this business. So who we are, very briefly, we are more like a bridge between a wealth manager and an AIF. Aditya initially spoke about, so 7.5 years since we've been working in this segment. Our job is to predominantly help a wealth manager develop the understanding for AIF, within the categories of AIF, what and how to choose and likewise. And similarly, for an AIF manager, we help for their outreach to the wealth managers for the right kind of wealth management players and family offices and likewise. So that's broadly and in a nutshell what we do. That ends the presentation. Unfortunately, I might have taken 5-7 minutes of longer time than scheduled. But I'm open to and willing to take up questions if Aditya has any. Aditya, over to you, please.
Yeah, thanks, Apurv. So, participants, if you have any questions, please use the ask question button and put up your questions there so that I can quickly put on to Apurv. I can see a few questions already here, so let me take them quickly. So, Apurv, there's a question for you. What does performance benchmark encompass for AIFs which are so diverse? Any suggestions from investor standpoint or aggregators who are monitoring this in Indian context?
Excellent first question, I must say. So first of all, performance benchmark are very, very difficult in this space for an aggregated benchmark to be created for performance. I will give a very simple example as to why this is very difficult. And completely Indian example only. And these are live examples that I'm giving, just that I'm not giving names of those kind of products for obvious reasons. Let's take a hedge fund as an example. You have several hedge funds in India that operate under the AIF license. Now, if we were to make a quick comparison of all those AIFs as one category, that category 3 hedge funds or long short funds, this is how the performance has been. It's almost impossible for someone to take the right judgment. There are such AIFs which are aimed at being market neutral at all times. That means that they do not take any directional call on the market. They are more like arbitrage funds remaining market neutral. Now that fund, you cannot expect to deliver 25% returns when your benchmark Nifty or a Sensex would have delivered 25% returns. Not possible because you're not taking those kind of risk also in this product. Within the same category, there could be one AIF which says that the benchmark is to generate absolute returns come what may of the volatility of the equity markets. Now, both might have derivative products within the equity markets as underlying, but the manner in which the equity is managed or your derivative is managed is drastically different. Now, if you have 2 years or 3 years of good market growth, and if your equity markets have delivered 15 to 18% returns compounded in this period, the first fund that I spoke about might still be languishing at about 5.5%, 6%, 7% kind of returns net of expenses. The second category of the fund could be delivering anywhere 12 to 13% also. You will feel it's doing very good job as compared to the first fund that we spoke about within the category. So you can't generalize. It all depends upon your objective and whether for your objective a particular return category is useful or not. Now, just elaborating this more, a little more, because this is a very important question. Even if you were to take a directional call, somebody will take a directional call keeping in mind that it's meant for an aggressive investor who wants higher returns than the benchmark. And there could be one product which says that you want the returns to be in line with the benchmark or slightly higher, but the primary objective is to cut down on the volatility and therefore to cut down on the drawdowns. Now that also would mean a lot of difference between the two. Right? So there are a lot of factors for you to benchmark. Again, these are products which we are talking about where there are no exit load restrictions. If there are exit load restrictions, then your entire categorization, your performance numbers, everything might take a backseat. And let me give a very simple example, which will give you the sense of how critical a due diligence can become at times. Again, for obvious reasons, I'm not naming. But if a venture capital fund comes and talks to somebody and talks about for a 8-year tenure of the fund, and if it has got a key man risk, the person may have a great pedigree, may have done a great job in the past, but he carries a key man risk. And I add one more dimension because this is one practical case that we have had in the past. And if the person is a chain smoker, about 60 years of age, we might have outrightly rejected the product also. With all due respect, when it comes to due diligence, you have to look at things very, very practically. So the point that I'm trying to drive is performance alone cannot be the matrix to decide everything. Performance is important, but it can only give you some indication. And unfortunately, you don't have categorizations within a category of all these buckets. The day, SEBI, the way in which SEBI has come up in mutual funds saying that a mid cap has to be a certain percentage of mid cap for sure, and a flexi cap will have these definitions. If we have that in venture capital and private equity in AIF someday, then the performance benchmark will be important. But then if that happens, then AIF industry will have no flexibility either. So this is how the answer could be. Aditya, I'll be short in my next answers, please.
Sure. Okay, moving on to the next question. Why are the funds raised versus commitments much higher in case of category 3 funds than in Cat 1 or Cat 2 funds?
The category 3 does not have, in most cases, drawdowns at the moment you give money or you commit money. The entire money is then almost immediately called for. And the money that is called for is almost immediately deployed also thereafter. So in that case, if I'm committing 1 crore, I'm actually giving 1 crore immediately. In Cat 1 and Cat 2, the money is called for in stages in most cases. It is not mandatory that you need to call in stages or in drawdown phases. But the reason you see more, less of variation between all three numbers in Cat 3 is because the money is called up almost immediately.
Okay. Next question. Are the AIFs required to or voluntary disclose NAVs in the public domain? If yes, at which periodicity?
No, so in public domain, you don't get all this information. It is only available privately. And we've still not reached a stage where this is a disclosure made in SEBI's website or anything like what we have in case of PMS. The periodicity, bare minimum that has to be there is every year for the investors. But most of the money that is raised from investors today, there is a periodicity of at least half yearly that we see in most AIFs.
All right. The next question: how deep is the family office investment pool in India currently? On average, how many active family offices do you have? Do we have?
Sorry, I lost the initial part of your question. Sorry.
How deep is the family office investment pool
Okay.
currently, and how many active family offices do we have? What is the average size of corpus, and how many investment do they make?
Correct. So again, an interesting question. See, the word family office also does not have a definition that any large family or family office with the size of 50 crores and above is considered as a family office. So let's divide both between multi-family office and single family office in two sections. Generally, when I have a reason to believe that the family office term that you're using about is more tuned to single family offices. Uh, yeah, so single family offices, the pool is significantly large. Now it does not come on the surface because most of them make very discrete investments. Uh, Unless and until some of the investments, the companies would want them to make it very, very public. So that pool is significantly large. Putting a number again in absence of credible data is slightly difficult. But the count, if we were to look at of sizable family offices, which are upwards of 100 crores managed individually, that count would be in three digits very easily. And mid three digits, not too far from mid three digits also. So they are significantly large. Now, whether they are managed as family offices per se, or they are managed more as sophisticated wealth investors could differ. But increasingly, we are seeing this getting converted into structured family offices now. And the very interesting part is we see such kind of things happening, not just in metro locations, but in tier two, tier three cities. That is catching up significantly well.
All right. So the last question, Apur, what are the same steps take? What are the steps taken to increase individual participation in AIF? And also, how would an increase in individual participation affect AIF structure?
Okay, so let me say that it is the industry which will have to come together in some ways to sort of have slightly better or to create a slightly better understanding of AIF as a category amongst wealth managers. That is one requirement which I believe is a very, very important requirement for AIFs as a category to grow. Well, how is this going to affect the investors? Many ways, because once this grows, you will see SEBI also becoming a little more stricter in terms of disclosure norms and bringing about transparency. I'll give a simple example. It's not easy for me to find out what's the total corpus a particular AIF has raised so far, right? But if I want to check that what is the total AUM a particular PMS has today that they are managing, discretionary, non-discretionary, both, that data is easy for me to get. The moment you have an industry which has grown to a slightly better level, I'm sure those kind of transparencies will come in, and investors will eventually know how a particular AIF is growing and what it is doing. The reason why it is kept as private placement is that this can, the moment certain kind of transparency can become a double-edged sword. And this is important for everyone to understand. If suppose SEBI was to come up and say that it transparently needs to, every AIF needs to transparently share what is the investor money that they have been able to raise so far. The moment that happens, every investor will wait for a certain corpus to come in before they commit the money. And no AIF will be able to grow thereafter. So the challenge remains that it is the investors' money with which the investments will start happening. So, and I'm talking about more of Cat 1, Cat 2 here. So if there is a real estate fund which is there out there in the market, the moment you have pool of investors who commit money, the fund manager will go out and make commitments for some real estate lending somewhere. In absence of a little bit of money, you will not make that first money also. And that any benefit will accrue to the initial investor. So he's not losing out on anything. But generally speaking, SEBI will bring about a better quality of transparency and reporting structures if this industry grows. And I think we are not too far. We are almost there from an industry growth perspective. With the numbers that you have already seen, we can't say that industry is not yet grown. It's the participation that has not yet grown. Participation is my personal view is participation is not too far away for it to double up from the retail or the qualified investors in the days to come.